And we are back at the Big Money Big Daddy Show, bringing it to you this Thursday afternoon. I have no idea why I'm laughing. Stop it.
Well, it's because we're laughing at the first segment. What we were trying to explain in the rate of return calculations, we realize is almost an impossible thing to try to do on the radio.
It's just one of those. So if you had no idea, if you were listening in the first segment and you had no idea what we were talking about, that's why you need Wealth Design Group. That's why you need Mark and Dale in your corner. We will help you understand what your real rate of return is. That's why we're doing the show today.
Yeah, I mean, one of the first things that we do when someone calls in, they set up either a face-to-face meeting or a webinar, or they come to a coaching session, is we run what's called a portfolio MRI, which takes a look into all the investments that you have, whether they're through your company, 401k, or outside investments, and shows you the truth of what your asset allocation is. Are you really diversified, or do you just own a bunch of stuff? That shows you here is the returns of those asset classes, and then it can compare those to what we call our efficient portfolios. And we've talked about the Markowitz Efficient Frontier and some of the things that we do that's really our strong point that we have at Wealth Design Group. But that's one of the first things. That way you're putting everything on a level playing field, so you make sure you're looking at real performance all calculated the same, so that you are empowered to make the decision of the direction that you want to go with your portfolio. Make no mistake about it. We believe if we empower you with information, we speak the truth, you will come to your own conclusions as to what you want to do with the future of your finances.
Which is why we do the events that we do every month. So I know we try to mention this as much as we can, but text the word daddy to 72727 to get registered to figure out when our next event is, which is going to be September 22nd. That's going to be at Perry's. We actually have one tonight, but it's standing room only, full house. You have to drink your margarita standing up if you come to Papacitos, but we're going to be delivering great information, and that's why we do these events, to get the message out there so you understand what you're doing and why. So text the word daddy to 72727, or you can call or text us at 713-826-0426, or check us out on our Facebook page, Big Money Big Daddy.
Awesome. Okay, so we wanted to go into we talked about the two methodologies of using average rate of return versus annualized. And annualized was a better reflection of how to calculate your returns. The simple example we gave is you have $100,000. It goes minus 50% in year one and plus 50% in year two. The average would tell you that you had a 0% rate of return, but your account statement would say otherwise, because it would say you only have $75,000. Well, that's a loss. Annualized would show that your annualized rate of return was minus 13% for each of those years. That is a better reflection. But you knew it was coming, didn't you? It gets even more complex than that, because what about when you've got money coming in and money going out of a portfolio? Well, there's three ways then of calculating the returns. There's what's called the simple return. There is the money-weighted return, and then which is also called the internal rate of return / dollar-weighted, but let's just call them simple return, money-weighted, and the time-weighted return. And I think that's we're going to go into what each of these are. Let's look at the simple return. It's just the total gain on the net invested as a percentage of net invested. So in other words, if I have a $100,000 and it grows to $110,000, then the return is
10%. Pretty easy.
Yeah, there we go. That's simple, and obviously the benefit to using that method is it's simple to calculate. The downside, though, is the performance is totally dependent upon the time held, timing, and size of the cash flows. So it's not a good relative measure. So let me kind of give you why that is. So if we take that same example of $100,000, but we say that was just on December 1st, okay, and then the account value at the end of the year was 110, the simple return says I got a simple return of 10%. But
How about that annualized
yeah,
average?
but if you got made $10,000 every month for the entire year, you'd actually be looking at it over 100% return on a more of an annualized. So the simple return isn't factoring in the length of time. And so you've got to be very careful if you're using simple return, that if you were comparing to something else, that you were using the exact same time frame, and the monies that went in and out had to all be on the exact same days. And that ain't happening.
So even if you're comparing apples to apples, you can't compare a Granny Smith to a Red Delicious.
That's perfect.
There you go.
That's awesome. I like it. Okay, so let's just kind of throw that one out. Okay, that simple return.
I think everybody gets that one.
Yeah, everybody gets that one. So now let's have a little fun, Dale, because we're going to go into the money-weighted return. All right, so let's define it first. The implied discount rate or effective compounded rate of return that equates to the present value of cash outflows with the present value of cash inflows. Who caught that? Anybody get that one? All right.
That's pretty deep.
Yep. There's a formula. I can't even say it. It's sigma something or other, this, that, IRR. Okay.
You can Google it. Google money-weighted formula.
Yeah, actually, that'd be a good idea. Google that. And then it'll show you the really cool-looking formula for all of you statistics majors.
Told you we needed pocket protectors today.
We do need pocket protectors. Okay. Let's put that in as plain language as we can.
Dumb it down.
And this still is the aggregated weighted return of each individual cash flow. All right. So now what we're doing is we're looking at the rate of return based upon the money that came in and out at each time that it did, and then we're aggregating that.
Now you're talking about your 401k.
There we go. So like think of your 401k, and if we wanted to use a money-weighted type of formula. Now what's good about this is it's a better measure of the actual performance than simple return, and it actually is a good representation of your specific account performance. All right, and I'll give a little bit of explanation of what I mean by that here in a minute. The problem is it's heavily influenced by the timing or the size of the money going in or out. So using this methodology, although it's very accurate reflection of your specific return, it doesn't help you actually measure the performance of the portfolio itself. So let me help you see that, all right? Let's say that you invest $1,000, and in year one, it goes up by 10%. So you like that 10%, and then you decide you're going to put in $5,000, a much larger amount than the original $1,000. And then after year two, then the portfolio loses 9%. I mean, how many times has everybody out there done that, right? You got an investment and it does well, so then you go all in, and then
like doubling down at the blackjack table.
Right. You know, I was listening to a speaker a couple weeks ago, and he actually was a behavioral economist, and he said he was talking to a friend of his who was looking at doing some commodities investing.
Mm-hmm.
And she was telling him that, oh, don't worry, because she knew it was high risk. Don't worry, I'm not going to do much money. I'm just going to start with 5,000, and if I pull it off, then I'm going to go ahead and put all my IRA and retirement savings in there. What do you think about that? And he just said, well, I hope you lose your $5,000. Because that's
He didn't want her to lose everything.
Right.
Pretty good advice. I like it.
So
got to think about that one for a bit.
I thought that was pretty good. Okay. So, all right. So to continue that example, again, put in 1,000, grew 10%, and then we put in 5,000 and it loses 9. So the client lost $449. Okay. But remember, they actually did well for the first year, the manager of the portfolio got a 10% return, and then the manager of the portfolio in year 2 did lose 9, right? But because you put more money in the losing year, yeah, you lost money, and so your dollar weighted return was minus 6.47, okay? Which is true. You are down 6%. Make no mistake about it. But if you're looking at rate of return to evaluate the performance of the manager, that doesn't reflect that. That just has that reflected your behavior or the luck of the fact that your bonus was bigger the next year, or the luck of the day you put it in, or bad luck of the day you put it in. Nothing at all to do with the actual performance of the portfolio, really. Because the portfolio was slightly up in that example. It was up 10%, and then it was down 9%. So it actually made money. Now, you did lose money, so you've got to start to understand. And when we, as financial advisors, our job is to help you evaluate the performance of the actual portfolio, okay? So I think sometimes that's difficult for people because they go, well, I just look at beginning balance and end balance, and in this situation, they were down. Well, they would say this money manager wasn't good. But what you're not realizing is, number one, the money manager did break even in this situation, and then we would have to compare, what the markets did over that same period of time to see if that was good or bad. But maybe the markets were down 10% over that time, and actually that would have been a great money manager, but you, based on this rate of return calculation methodology, fire the manager and move on. You have no idea. You just made a huge mistake.
Right. I mean, we have this conversation all the time. We have the other conversation we always have is, say somebody had $10,000 or $5,000 they want to dump into the account, then it's always, should I put it in now or should I wait, a month till things look better, or should I wait for the market to drop and put it in? I mean, all those things come into play if you're trying to figure out when to put the money in. It's all about the timing and the waiting.
Yeah, I mean, kind of another way, I always just say the portfolio can't control when you put money or take money out. All the portfolio can do is be or the money manager for the portfolio. All they should, and what they should be focused on, is managing the money the right way. They can't control the rest. So in order to properly evaluate a money manager's performance, then you need to use the time-weighted methodology, okay? Time-weighted methodology, and again, we'll go into we're reading these definitions, dang it. We got to do it. The definition of that is calculation of sub-period returns between each valuation and geometrically linked together to derive a return for the period. That sounds fresh.
You can Google that formula too. It's pretty cool looking.
Oh, wait till you see that formula. This is good stuff. Google the time-weighted formula and you are going to love it. All right. So the best that we can, whatever you want to call it, make it lame, dumb it down. Doesn't sound as good as, what about layman's? Just dumb it down.
Dumb it down.
Dumb it down. All right. That is the performance of the underlying holdings of a portfolio, regardless of the time or amount of cash flows. That's how you actually would measure the performance. We're going to get into that, and we're going to get in the examples. We're going to show you which one's the best one, and then we're going to talk about what companies actually use in the last segment. So you're definitely going to want to stay tuned for that. But look, the bottom line, most people don't realize there's so much more, even in something as simple as rate of return. You need to work with an advisor. We want to help you. We will do what is in your best interest. Call us, 713-826-0426, 713-826-0426. We can just talk. We can set up a time to talk, face-to-face, webinar. We can have you come to our live coaching events. We have one tonight, but our next one's September 22nd. We can invite you to our webinar events. The process begins through education, But this stuff matters. And if you want to have the best chance for success as an investor, it's time that you align yourself with a firm that believes in the same thing, and that is doing what is best for you. So we want you to put that into consideration. Also, get on our list for announcements via text 72727. Text the keyword daddy to 72727.
Big money, big daddy.